Summary and detailed explanation of Mark Douglas's Trading in the Zone. Mark Douglas's Trading in the Zone is a seminal book that delves deeply into trading psychology, mindset, probabilistic approaches, and self-control. The central theme of the book is how to become a consistent trader through a fundamental change in approach to the market, providing a concrete mental framework necessary for success in trading. Below, we will organize the key ideas and main points of the book into several main topics. 1. The importance of psychology in trading. A prerequisite for consistent profitability. Mark Douglas argues that the reason most traders fail to achieve consistent profitability despite focusing on technical analysis, fundamental analysis, and indicators lies in psychological obstacles. And while the technical perfection of a trading strategy is important, Douglas emphasizes that a trader can only generate stable profits by accepting the uncertainty of the market, controlling their emotions, and adopting a probabilistic mindset. Psychological biases and errors. Fear and greed are the most prominent pitfalls of trading psychology. He explains that loss aversion bias, confirmation bias, and obsession with win rates cloud a trader's judgment and hinder disciplined trading. 2. Proper understanding of the market and uncertainty, the need for a probabilistic mindset. The market is a complex system of numerous interacting variables. Therefore, the outcome of individual trades cannot be predicted with certainty. However, from a statistical, probabilistic perspective, it's possible to calculate the success probability of certain patterns, or setups, and achieve long-term profits by repeatedly executing this probabilistic edge. What you can and cannot control. Ultimately, a trader cannot control the outcome of market movements, whether prices go up or down. What traders can control is their entry and exit points, position sizing, stop-loss/take profit strategies, and their own psychological state and behavior. Uncertainty is a given precondition. Instead of trying to avoid it, the key is to establish and adhere to trading rules that are probabilistically advantageous, based on this assumption. 3. Mindset. Focusing on consistency rather than win rate. Rule adherence is more important than profits. Beginners and failing traders often fixate on the win rate or high short-term returns. In contrast, professional traders focus more on whether they followed the rules than the success or failure of individual trades. Adhering to rules is maintaining one's own probabilistic edge consistently, which is essential for long-term success. Infinite game perspective. It's important not to be overly attached to the outcome of one trade, but rather to view it as one step in an infinitely repeated game. That is, it is just one of many trades, and the important thing is to prove one's edge over the long run. 4. Self-control and emotional management. The problem of fear and expectations. When traders are in a state of vague fear and greed, or excessive expectations, rational judgment is difficult. Being unable to enter trades out of fear of loss, or conversely, using excessive leverage or chasing after prices to maximize profits, are clear manifestations of a poor psychological state. Ego and faulty self-defense. The ego operates such that making profits enhances self-esteem while experiencing losses makes one feel personally negated, which significantly affects a trader's psychology. To mitigate this, it's essential to avoid equating one's self-worth with trading results. Even if a trader makes a bad trade, it does not negate their value, just as a good trade does not always guarantee profits. Discipline and confidence. One way to reduce emotional volatility is to have a clear trading plan and rules, e.g., entry/exit criteria, stop-loss/take profit targets, position size, and consistently adhere to them as a habit. The fact that a trader has followed their rules reinforces their confidence, creating a virtuous cycle that makes it easier to maintain discipline. 5. Probabilistic approach and the edge. Trust in your trading system. The edge in the book refers to a trading rule or system that, when executed repeatedly over the long term, yields profits on average. To find this, you need to research market data, backtest, or engage in simulated trading to establish concrete statistics like entering under X conditions has a Y% probability of generating a profit. A trading strategy should be established by proving their edge through dozens or hundreds of trades, not just one trade. Expected value, expected return, is more important than win rate. Even if a strategy has an 80% win rate, it may not be profitable in the long run if the risk-reward ratio is poor, e.g., +1 for a win, -5 for a loss. Conversely, even with a 40 to 50% win rate, a profitable system can be maintained in the long term if the risk-reward ratio is favorable, 1 to 2 or 1 to 3. From this perspective, it's essential to focus on a trading approach where the expected value, average profit per trade, is positive rather than focusing solely on the win rate itself. A stop-loss and position size. Risk management is essential to make the edge effective, with two important components. 1. Setting a stop-loss line, S/L system must be in place to consistently close positions before losses become too large. 2. Position sizing. You need to predetermine the percentage of your account you will expose to risk, adhering to it strictly to prevent any single failure from critically impacting your account. 6. The Trader's 5 Fundamental Truths. Mark Douglas presents several important truths that directly affect trading performance, core premises that traders must be aware of. Anything can happen. The market can have unpredictable situations occur at any moment. You need a strategy with a statistical edge to make money, but you cannot know if any single trade will be a winner or a loser. Every trade is an independent event, and it is only through repetition that long-term statistics emerge. You don't know how far the market will move after any single entry point. The market is unpredictable in when, where, and how much it will move, therefore, you must respond according to predetermined rules. Repeatedly executing a strategy with a statistical edge will likely yield profit in the long term. Not dwell on the outcome of 1 or 2 trades. Consistent repetition is the key. The market right now is unique. Even if patterns appear similar to the past, there is no truly same situation as in the past. Therefore, one should only take a statistical approach to similar patterns, not assume the outcome will be the same. 7. Practical guidelines for shifting mindset. Trade with money you can afford to lose. If you trade with funds that you cannot afford to lose, fear and impatience will hinder you from controlling your psychology. Use a self-check routine and trading journal before trading. Before actually trading, it is recommended to check if your trading strategy, entry/stop loss/take profit criteria, is clear, and 2. Examine your emotional state, tension, excitement, fear, etc. Keep a trading journal, trading diary, to record whether rules were followed in each trade, your psychological state, and market conditions, and to obtain objective feedback. A mindset training, meditation, visualization, positive self-talk. Actively use meditation or visualization techniques, picturing success, visualizing the entry/exit processes, etc., for psychological stability. A positive self-talk, such as telling yourself, I adapt to the market, follow a probabilistic approach, and adhere to the rules, is also helpful. A trade only with as many trades as your risk tolerance allows. Opening too many positions simultaneously or using excessive leverage will increase emotional volatility. It's important to trade only within a range you feel comfortable with to improve psychological stability. 8. Conclusion and key message. The biggest lesson of Trading in the Zone is that trading is a psychological battle, and adhering to rules through a probabilistic approach to the market and self-control is the key to success. The author provides a mental and psychological framework that allows traders to control their mindset, ego, fear, greed, maintain a predetermined probabilistic edge, and consistently repeat their trading. Simply learning techniques or strategies is not enough to survive in the market. Such a psychological and philosophical foundation is necessary for technical or fundamental analysis to become truly meaningful. Closing. Mark Douglas's Trading in the Zone is recognized as a masterpiece that underscores the importance of a trader's mindset towards the market and methods for managing and controlling one's own psychology. The message: before learning any technique, first understand yourself and adopt a mindset that fully accepts the uncertainty of the market, continues to have a significant impact on many traders. In summary, the book emphasizes probabilistic thinking, emotional control, and disciplined execution. The core value of the book is in showing that the fundamental reasons for the repeated failures of individual and institutional traders lie in their psychology, providing concrete examples and methodologies. Diligently reading this book and applying it to actual trading will lead to the effects of self-control and mental discipline, which go far beyond the level of mere knowledge.